Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most and do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
Welcome to The Wealth Flow. My guest today is Patrick Grimes. Patrick is the founder of Passive Investing Mastery, a company dedicated to educating and providing alternative investments. He is also the founder of a private equity firm, Invest on Main Street, where he has acquired over $600 million in real estate, including 4,000 units in multifamily apartment communities across Texas and southeastern U.S. He's diversified his investments to include energy, including 100 plus natural gas and oil wells, and 5 locations across 5 states. He's also a partner on a best-selling Amazon book, Persistence, Pivot, Game Changers, Turning Challenges into Opportunities. In his prior life, he was a mechanical engineer with a BS in mechanical engineering and an MBA and MS in engineering, and was inducted into the Forbes Real Estate Council to contribute to Forbes magazine on commercial real estate topics. So Patrick, welcome to the show.
Glad to be here, Keith. Your show's right in line with our vision at Passive Investing Mastery and Invest on Main Street. So will be a good, friendly talk today.
Absolutely. And I can't wait to dive into a lot of the things we've talked about in kind of the pre-show. But as I start with everybody, I'd like to kind of get some background on you. Where did you grow up? And you know, obviously you took a different path initially with the mechanical engineering, but what led you to real estate?
Yep. So we did bounce around a little bit growing up. So I tend to say where I grew up was where I spent my formative years. I was born in Italy. My dad was in the U.S. Air Force, and we lived in Florida for a little while in Southern California before settling down middle school, junior high, and high school up in Yosemite National Park, South Side, Oakhurst, Bass Lake, Mountain Community. So I went to Yosemite High School.
Wow.
Mountain Bay, yeah.
Beautiful up there for sure.
Yeah, we were raised with just bunny ears on a TV, fuzzy channel 8 and 11 watching. If we didn't turn on the TV, it was Matlock or Murder, She Wrote. So we spent most of our time, out on the mountain. Our backyard was a hill that we could snow sled down, and we went rock climbing and sailing and hiking all the time. So it was good to be in nature. Moved to the city when I went to college. So I made it out on the mountains, and engineering was great. I loved it. I'm a geek eternally, and my heart still today, even though I don't do that anymore. But yeah, I did well, and engineering was a great path, and I still am passionate about it today, but it just wasn't going to get me and my family where we wanted to get to. So I ended up having to pivot.
Yeah. And you pivoted into real estate. How did you start in real estate?
Well, it was back in so I worked at some places, kind of like 8-month internships, but my first real job was a company called Kinematic Automation up in the mountains, north side of Yosemite National Park, actually, and was doing automation and robotics. And one of the owners that I got to know very quickly, who still invests with me today, really solid guy. I mean, this was a long time ago. And he said that his only regret was not investing more sooner into real estate. And I'm like, wow, what? He goes, you're going to be very talented in this high tech space, but don't put all your eggs in that basket. Diversify, put your investments in real estate more as you can the sooner. And so that's what got me on the path. And I was rocking because I jumped in head first, snot-nosed college grad, inexperienced, bought into what was the highest returning asset class I could find, which is pre-development, hoping to develop and build. And then 2009 and 10 happened. So I lost it all. And I dove very quickly, and I learned the hard lessons very, very early in my career. But I was able to climb out. I went through foreclosure. I avoided bankruptcy, paid debt forgiveness, all 9 yards. I lost the property, but I was a talented engineer doing well. So eventually I was back in the seat again with income to invest. And I just learned how to do it in a lower risk profile, invest like the wealthy, be the tortoise, not the hare.
Yeah. Maybe we can expand upon that a little bit. And I'd like to kind of hear, maybe Patrick, you've been through 2008, 2009 timeframe. A lot of folks are saying that there's at least, right now we're going through something. Is it the same? There's different dynamics around this one versus the last, but what were some of the lessons maybe you learned, and what are you doing differently on your investments to be that tortoise versus the hare?
Well, this can be a whole hour-long conversation right here because I have a whole theory behind this, and I write articles and forums on all this. So what happened in 2009 is very different than what is happening now. It was actually the single largest instance of fraud, buyers were not qualified. They didn't have the reserves. They didn't have the income. And so there was just really not any there behind the loans. And now, these days, there is. And the challenges are different that we see today. But the principles, as you say, what is it that allowed us to be the tortoise, not the hare, to build a portfolio that would ride out recessions? The principles are somewhat similar because even though COVID and interest rates and inflation show up a little differently than what happened in 2009, they're still financial disasters, right? And there's some similarities. And, some of the things that right off the bat, I learned you need to buy for cash flow. So I don't do development and construction anymore. I like to buy income producing, cash flowing assets. Great. Right on day one. And I like to buy ones that I can get at a discount, that I can work harder to find the right deals and make a measurable improvement to increase my position, go to work and improve it, but not create something out of nothing. Right? Not gamble, not slide the big stack over on green 24 anymore. But the principles from there, aside from being cash flow, is recession resilient markets, which means we're looking for places that didn't just do these massive swings like they did in 2009. Mostly that's places with diversified employment that are stronger in recession resilient verticals. And so once you're in the right spot, you want to find the right asset that's cash flowing. And then you've got to put a really strong foundation, financial foundation, which means long-term fixed interest rates or cap rates, cap debt, so that if interest rates go wild like they have, you have put up enough down to cash flow. You put up enough down so even if interest rates rise to your cap, you can still cash flow and ride it out. But then when we found COVID is an economic disaster, right? Because people stopped paying rent. Maybe rental assistance helped a little bit, but then that went away. But the eviction ban finally picked up, but then they're backlogged, right? So that is equivalent to a tornado hitting your property and you can't collect rent. It's the same thing, same financial disaster. People in your property and you can't collect rent. So we put 8 to 10 months in operating reserves. So we'll raise enough capital to pay the down payment. We'll raise enough capital to fix it up. We'll raise enough capital for operating reserves that allow us to pay all our bills for 8 to 10 months. Means literally turn off the spigot. And so kind of the combination, and then we have replacement cost insurance that will both rebuild the building and pay back the rents in case there is actually a natural disaster. So the combination of those general principles are kind of the foundation. And then there's just layers of nuances beyond that. But the point is to not become the distressed owner that we're buying these deals from, because we're buying deals from people that they're great performing assets.
Yeah.
but they didn't have the forethought, the preparedness to build it, to buy it and structure it in a way to survive. And so we approach it in a way where if we can't do it and not become those people, if we can't do it with these principles, we just don't do it.
Yeah. Well, there should be a lot of opportunities like that, I think, coming up here. I'm sure you're already seeing them, but yeah, I mean, those sound like great principles that you've put in place for sure. Before the show, Patrick, we were talking a little bit about single family and kind of starting with single family and then moving into multifamily. And I know you've written the articles on it there at Forbes as well. So maybe if you could give the audience just kind of your opinion of the two and why you prefer multifamily from an investment standpoint.
Yeah. So I have Patrick Grimes Forbes single family versus multifamily would get you there, or you can go to our website, you'll find him, or Patrick Grimes Forbes asset protection. I think those two combined, you need to really put together the story, because I did do single family before I traded up into multi, and I was a high tech professional. I was a high paid professional, probably like many of your listeners, thinking that, well, the American dream is to become a landlord. So, right. And I'm really good at what I do in automation and robotics. So I'm obviously going to be really good at buying my own place and renting it. And so it turns out that while I was successful at that, and I was buying properties, but I wasn't buying in my own backyard. I was buying them where it made sense to buy, where I could cash flow. The economics were so I said cash flow, where it was recession resilient. It was landlord friendly in Texas, and I'm in California. And those properties did very well. But the problem was I was still learning. I'm an academic. I was downloading every book, listening to everything, reading every guide I could, but I was still making it up as I went along, and it was with all my own money. But that's a lot of stress and a lot of challenge. And when I was dedicating most of my time to this job that produced the income that allowed me to invest, I was having to moonlight my real estate career, which I went whitewater rafting the Grand Canyon. I've hiked Fuji, Shasta, 14ers. I've done a lot of stuff. I've base camp of Everest. You can't do all those things that really build an actualized life if you're slaving away by day and slaving away by night. So
exactly right.
It was actually right. It was actually my wife my soon-to-be wife that came on the scene, and that's when I finally said, "Look, I need to take a break." And I told her, she was there for my very last single-family closing. As while this is working and while we're finding properties, improving and pulling out our capital and holding and building a portfolio, I need to take a break from this. And then we got married in California, in Beijing. But also, aside from just the time, it just wasn't scalable. Trying to get to 20 or 40 properties on a single family basis in the Midwest, you need to really build that diversified retirement. Getting there is extremely painful, and it's a one stair step at a time. And so we saw that the life we had at below 10 was going to be very different than the life we had at 40 to 50. And so it took some time for me to kind of reset, learn about other options, scaling into multifamily and partnering. Try not to do everything myself. I don't go and try and be my own mechanic. Why am I trying to fix my investment portfolio all on my own, right? And that's the art of partnering. And it turns out that not only does the trade to syndicating passive investing or syndicating the larger apartments or owning larger apartments scale easier, and you can do it in better markets more efficiently, but it's less risky. You can spread out your investments if you're passive investing, and you don't have to sign on the loan, sign on the property, which expose you to frivolous lawsuits or the lender coming after you like they did me in 2009 and 10. I didn't know what cross-collateralization was then.
Right.
Most of my investors don't know what it is now. And so that's all education that is good stuff. And those articles I wrote try and really kind of bring it home, just personal experience. Also the book, which we'll give away at the end here.
Okay. Yeah. Fantastic. And so that it's just it's scalable, a whole lot more scalable to do multifamily. What are some of the other advantages that you found with multi?
Well, so Yeah, the tax advantages are significant as well. In single family, you're kind of stuck at this 27 and a half year, right, depreciation schedule. It's so small, a lot of people don't even think about it in single family. It's just not even on their radar. Maybe their CPA does it in the background. But when we buy a larger multifamily deal, we'll do something called a cost segregation study, which allows us to pass through significant passive losses in the first year, oftentimes somewhere between 50 and 70% of our investment in the first year, which is awesome. It's awesome for our investors because if they have other investments, it can help to offset those gains.
Yeah, for sure. And so how does that, maybe go into that a little bit on how that works, what the process is to get the cost segregation. And then obviously, I'm happy to have you speak to, bonus depreciation and kind of some of the changes that are happening right now with that.
Well, if you're a passive investor, there's virtually no work for you. You once you sign the docs and wired your funds in, a K1 shows up and you'll just see a bunch of passive losses. So you'll be in a really strong position off the bat. Behind the scenes, we are hiring an engineering firm / accounting firm that does a cost segregation study. And so they'll take the property and they'll add up all the components in it, right? And say, oh, there's this many light sockets, this much in flooring, this much in appliances. And then they'll put those into different buckets. And in each of those buckets, you can say, well, this is allowed to be depreciated faster than 27 and a half. And this one's allowed to be depreciated faster. This is 5, 7, 11 year buckets, right? And so you put all these in these different buckets, you can accelerate these different things. How much when you do in a multifamily building? A lot of the price are these rapidly accelerating components, things that don't last 27 and a half years. So if you spend the money, which really only makes sense in larger assets like this, you can get a high percentage of that price accelerated with accelerated depreciation. Now, bonus depreciation was signed by Trump, and for a number of years, you can take 100% that price of the depreciable losses or whatever. Like you buy a property for 20 million, maybe you can depreciate 15, right? Or 17,
right?
Faster. We could take 100% in the first year, meaning like you invest 100 grand, maybe like 75% of your investment shows as a phantom loss. And that's really cool for some investors. And definitely helps to allow for your cash flow to be offset. Now it's down to 80 and it's going to step down to 60 over the years. But right now we're still passing through anywhere from like 40 to 60%, depending upon the asset and paper loss in the first year. And like I said, at the very least, it means for most of our investors, their cash flow that we push out monthly gets offset. But for other investors, maybe that they're real estate professionals, they can have their entire income offset, like their active income offset, right?
Right.
And then on the energy side, even if they're not real estate professionals, what they call the IDCs, intangible drilling costs, that depreciation offsets active income, even if they're not real estate professionals. So that can be very, very significant. So we use that across the board on all of our investments.
Yeah, maybe while we're on, I know we're talking multifamily, but you just brought up how the depreciation works on the oil and gas. Can you give us a little bit more color on that, and how that's different, and maybe reiterate the real estate professional status, because not everybody, obviously, that's listening is going to have that or be able to do that, but the oil and gas depreciation, they certainly would have the ability to.
Yeah, it's a really good question because, and I get it a lot. People talk to me all the time, well, I can't be a real estate professional, and so I can't take advantages over the ordinary income, my W-2 income. I can't take the passive losses that you give me and offset my ordinary income, my W-2 income. And then sometimes they'll say, well, actually, my wife's a real estate professional because she manages a rental property of ours. And then so if she does the investment, then she can write off her real estate income if she has it, and also her husband's through the 1040 her active income, maybe a surgeon, lawyer, doc, whatever. So there's ways people work to try and make the passive losses in real estate offset active income. Otherwise, if you have passive gains, like you sold some real estate, that can help be offset by the passive income. But sometimes it's just not the case. You can't become a real estate professional. Your wife can't become a real estate professional, but you'd like to figure out how to invest to then get an ordinary income write-off for your high income. That's the kind of the holy grail. And you got to be careful first, because there is a lot of strategies. There's probably a handful of strategies out there which claim that they can do this, but it's risky and there's no real tangible asset there. It's kind of a hope, or, and so in those cases, it's kind of like the tax tail wagging the dog is what we call it. You got to make sure that you're investing in the right investment first, and then is it a tax advantaged investment second. So we tend to stick with recession resilient, non-correlated investments. And so in addition to real estate, we're doing energy, and we're not currently right now what we did last year. We don't have anything open at present, but in that particular one, you got to be a little cautious, because there's a higher risk profile with energy, but I like that it's investing in an essential need. The government subsidizes housing and the food and energy and healthcare, right? So right. If you can be clever about investing into those energizing and feeding and housing, and some investments that we're looking at presenting and keeping America healthy, the government will reward you with these tax advantages. And it seems like every so often I see some kind of hate about, oh, this person didn't pay taxes, and the wealthy don't pay. Well, it's interesting, because if you go buy a Ferrari, you're paying taxes, but you're not helping anybody out. But if you invest alongside of the government in oil and gas drilling, they give you intangible drilling costs. That's similar to depreciation in real estate, right? You invest in real estate to house, they give you depreciation, right? The differences between those two is that, and like we said, if you're a passive investor in real estate and a syndication, that would be passive losses, which we talked about. But in oil and gas, the intangible drilling costs, if you invest in a certain way in certain types of vehicles, they can be passed through as an active loss, so it can help offset your year one income. There are other investments which provide for similar kinds of offsets, but we don't go into all of them today. But you don't have to become a real estate professional to get the benefits in oil and gas intangibles. That just comes through as being an investor in a specific type of oil and gas investment, which is just oil drilling, old school oil and gas drilling, where you have intangible drilling costs.
Okay, fantastic. Yeah, that's interesting. And was that a pivot after COVID, as far as you raising for some of those deals, or what did that look like? In other words, what led you to go into the oil and gas?
If you go back to my passive investor guide that I created, and it's on my website, it's a free download at investonmainstreet.com. Right at the front of that thing, I have the diversification of the wealthy. And that's really what my whole journey has been. It's been trying to learn how those who have exceeded, even that founder of the high-tech firm I was working for succeeded, he claimed, because of his real estate investments, right? It was following the breadcrumbs of the wealthy, and ultimately those lead to a diversified portfolio, not just real estate. If you go to our new company, which we invest on Main Street, which grew to $500 million in acquired assets and partnership in 4,000 plus units around the southeastern states and Texas, a little bit in the Midwest, but we grew a large real estate portfolio. But when I was talking to investors, I was always saying, don't put more than 5% of your portfolio into one deal. And here's the asset allocation. The middle class has 8% of their wealth in alternative investments outside of the stock market. But high income and ultra wealthy have between 25 and 50. Business is this real estate, equity. If you look at Tiger 21's allocation, they, which are a group of people that have over 20 million in net worth, and they publish their allocations, they have 26% of their wealth in real estate, and then another, I think it's 27 and 26 in private equity. So they are diversifying into alternative investments, right? Those investments tend to be tax advantaged that provide essential needs that are non-correlated, meaning they don't rise all and fall at once. So people that are going all in high tech, well, it's not a good allocation strategy. All in real estate, not a good allocation strategy, but providing a balance. And that's why when we launched the energy fund, we said, look, it's an advantageous time. Let's launch this. At this point, we see prices of oil and gas strong, and let's get into a cash flowing fund and let's diversify. We got such an overwhelming response from our investors that said, hey, look, this makes a ton of sense. We need more of these. We didn't even know they existed. They're usually reserved for the institutional investors. We need more of these completely alternative, non-correlated ones that don't rise and fall together, assets that are non-correlated. But why are you doing it from a real estate company? So we founded Passive Investing Mastery because ultimately we, just like my portfolio and my friends, where we trade alternative investments like baseball cards, they're really only known to a few of us. So we founded Passive Investing Mastery to say, look, we may do real estate with Invest on Main Street, but we want to do consistent educational webinars to educate on ATM funds, laundromats, car washes, self-storage, all kinds of different alternative investments, which we just did a panel on. All those came up and more. All kinds of alternative investments which have different recession resilience, cash flow, and appreciation to outpace the stock market, and then provide those investments. And so we have the Recessionary Acquisitions Fund and our Income Fund, which is a asset-backed debt fund, both in Passive Investing Mastery, and we're adding some more here to those to help educate and bring those tier one, best-in-class alternative investments to both educate and bring those to our investors. And that's really the journey that the company's undergone.
That's great. And I think it obviously gives you a good perspective of all the different things that are out there. I've got several friends that have invested in the ATM thing, and there's some depreciation you can get from that as well, I believe. You could correct me if I'm wrong, but I think that there's some kind of a depreciation or something that you can take year one.
There is.
Mm-hmm. Yeah. And then the car washes are super popular right now as well. I see that kind of going around as well. So there's a lot of neat things out there that aren't specific to real estate, but that give folks some options when it comes to investing. So that's neat for sure. Let's
absolutely. And people need that community. Sorry, go ahead.
Oh, go ahead.
Oh, people need that community, right? They need to not just Google search and find like, oh, there's a car wash. What does that even mean? They need to find a community where we'll educate them on possibilities, introduce them to people that are doing it so that they can see themselves actually like others who have succeeded. Just like I did. I needed to seek out those people that were in my profession or in my circle that had done something to really think it was possible for me and to really energize me, and then get the right kind of advisors, people I can ask questions to, so that I had a community that was committed to developing my financial future, not just a circle of your work friends that are focused on putting stuff away in the 401k and IRA.
Yeah, exactly. That's neat. Why don't we talk maybe a little bit about, before the show, we talked a little bit about self-directed IRAs and being able to invest in some of these alternative investments, utilizing that tool. Can you dive into that maybe a little bit?
Yeah, so I do have an article in Forbes, and if anybody wants to go deep into it, it's Patrick Grimes Forbes IRAs 401k, and you'll find it. Just hit in Google. But for the most part, I worked in the high tech business doing automation and robotics for some of the largest, most successful companies, the Teslas, Lockheed, Abbott, Johnson & Johnson, Boeing. We did all kinds of really cool stuff for new and innovative gizmos and gadgets out there. And each time I was just so blown away when I get into these facilities and I was working with just some of those brilliant people in the world. And I would learn that their their understanding of investing was very, very limited. Maybe back then they weren't doing crypto so much, but maybe they were day trading, or they knew one or two things. But I was so interested, I was always asking, like, hey, how are you guys investing? What are you doing? For the most part, about 90% of them had either all of it in with their 401k or IRA, and mostly in index funds, because they're talking to a financial planner and that's all that they sell.
Right.
They won't sell away, or else they lose off their, or they had it in stocks and startups, or they had it in stocks in their company, and they were like, oh, this, we're going to go IPO. And none of it was truly diversified outside of Wall Street. Very little, if any. Or maybe they bought a rental home and that was it, right? And Lake Tahoe rental home, and somehow that was going to get them there. And the interesting thing is that in your 401k and IRA, while most people think that your funds are trapped there and you're stuck with a financial planner, if it's an IRA or a past 401k, you can tell your current, hey, I don't want you to manage it all, and you don't have a say over that. And you can reach out to some of the self-directed companies. There's a lot of them, and we've been on webinars for about a dozen great self-directed IRA 401k custodians, where you can peel off maybe 10, 20, 30, maybe like the wealthy, 50% of your retirement account. Pull it out of traditional investments and get it diversified into alternative investments. And when you do that, you basically roll part of it over into this self-directed account, and then you can invest in all kinds of different assets. You can buy gold, you can buy silver, you can invest in a car wash, you can invest in a multifamily deal, you can even invest in an income asset-backed debt fund, right? And that will allow you to then invest more like the wealthy and unlock what most investors think is this kind of trap there until they're 59 and a half and they don't have access to it. Allow you to unlock that and truly get some exciting growth and appreciation that will get you that retirement faster, right? And get you a safer, more balanced portfolio. Because the worst thing in the world is, your time to retire, and it's in a down year for the stock market, and you don't have any funds other than that. So every time you pull money out of your retirement account, it's like a 5 to 10x hit, because the market's been hit so bad, it won't rebound. So you really need to have income streams aside from your job and aside from dwindling down your retirement account. You really need to find those alternative assets that are non-correlated with Wall Street that'll get you there, to have a safe plan to retire when you want, and to be able to not dwindle down your retirement until you die, and build your retirement to leave something to your heirs and live the retirement of your dreams. And really, that's kind of our goal at Passive Investing Mastery, is get people to that point, and then get them to the point where they can then have the financial resources to give back and to produce the causes, for the causes they care about so dearly in this world. And I really think people should be aiming there, not just the financial stability or financial freedom, but to have the resources to make an impact. And that's our goal.
Yeah, that's great. And and tell me a little bit more about that community. Is it like a mastermind, or is it just a group of people that meet? What does that look like?
So we have started every couple of weeks we're doing panels. We just had a couple car wash guy, laundromat guy on the last one. We just did actually one on AI this last week. And so we created these environments where people could come up. We talk about different topics. We field a lot of questions, and we bring in some experts to some spaces. And every time people will be like, I had no idea that even existed. This is cool. This is great. And we're in the process right now of building out a Facebook community so that we can allow the investors to begin to connect. And that's, so we peeled off the last 2 investments, acquisitions and income into it. And then later this year, we're going to start adding additional different channels to it. And so we can start building that community of people that are all in the space.
Oh, that's really neat. What, before the show, Patrick, we were talking a little bit about some of the current stuff that you have going on. You want to maybe dive into some of that and why it's set up. I'm particularly interested in, the fund where you're buying assets, distressed assets, but for basically all cash, and they're cash flowing, from day one to the investors.
Yeah, so we have a recessionary acquisition fund, which is the sister to the recessionary income fund. And the income is the debt side, and the acquisition fund is the equity side. And what makes it recessionary? Well, as we talked about, the higher interest rates and inflation and with the bank constricting issues that we've seen, have caused a lot of properties to become financially distressed. I mean, they're great performing assets, but the ownership didn't quite build it to last through these trying times. And even if you're a very skilled operator, you may just got unlucky. And the year that your loan is expiring is this year when interest rates are high and people aren't buying, and you've got a performing asset. Well, that's only going to continue to grow as we get closer to through 2025, because we have $1.5 trillion in commercial real estate debt, short-term debt coming due, all at the same time when people are struggling with the higher interest rates, the inflated costs, and evictions lingering from COVID. Atlanta area has 12,000 backed up evictions right now. It's pretty amazing. But again, performing assets that need debt, and we have the ability, or need financial relief. And so we have the ability, and we have this acquisition engine where we're reaching out to owners directly. We will use a broker if the owner wants, but we want to make sure we get the owner first, because we're looking for those people motivated to close very quickly. We're looking for those people that brokers haven't whispered pricing that's so high they're never going to sell in their ear, that are individuals willing to sell at a basis where we know we can make a solid return on the buy. The last asset that we picked up, for example, had appraised a couple of years earlier for $4.7 million. It had fallen to 60% occupancy, and the owner was disinterested, inherited it from his dad in California, and this is in the Midwest. And we were able to pull in there and do an all cash buy and close in 14 days. We did the due diligence in front, but from when we closed, and there was 2 other higher offers, but we were able to move quickly. Right after we closed it appraised for over $5 million, and as is, with at least a value of $8 million. And so the ability for us to essentially provide very little to no capital into the deal to get an immediate return is our goal. It's to be able to project, hey, here's the returns we can make just from buying right. And where my crystal ball's broken today, it's what happens in 3 to 5 years, because interest rates and inflation and everything else. So what we're doing within the fund, instead of holding it and spending a ton of money improving it, we're not doing that. So we're buying it. We're immediately pulling out our capital, and then we're buying a second asset within the fund. So we're not distributing refinances. We're distributing rents. I mean, this thing was bought at a 10 cap, which means it puts out a ton of cash flow. We're distributing rents, but we're going to take that refi, we're going to buy a second asset. And then we're going to take the first asset with a few months of improvement, and then we're going to 1031 exchange it forward into a third asset. So that one asset became the second and third asset. So 1 to 2. Do that again, 2 to 4. And so by constantly, with quick agility and velocity, stepping up the equity, the gain, and the fund, you can get some exciting compounding returns. And each step I can calculate, because I know today I can buy the asset at a discount, and I know I can trade it forward at a better price now. So that means each step of the way, we do a very low risk step. A bad day for us if we're somehow off, which we're not, because people are bidding higher than us on these assets and we're just closing quicker. But if we were off, we just sell it for what we bought it for, right? But so it's not a bad day. Everybody loses everything. But so far, we know exactly what those stair steps are. And eventually, those deals probably will dry up. Maybe in 2-3 years from now, when everything's stabilized. We weren't able to do this 3 to 5 years ago. We probably won't 5 years from today. But for now, during this recession, buying right and trading forward, refining out and trading forward, that's the best. That's the lowest risk path the analyst in me sees and can calculate for building. And the returns are high. I mean, because we can compound that growth, and we know we're buying right as we go. So produces a pretty high return.
Yeah, that sounds very interesting. And how are you finding some of the owners on these things? Are you working through banks that are kind of identifying these as opportunities, or do you call directly to the owners on it and try to intersect it that way, or how are you going about finding them?
It's a really good question. And the slide deck of our investment, we do kind of go over what we call like our proprietary acquisition system. And that is a bit of the secret sauce, because we have intelligent software overlaid with other tools that provide for certain characteristics that we look for to suggest stressed operator, but performing asset, to kind of narrow down the millions of assets, down to certain ones in certain regions that have certain characteristics. And then we have a team of people that do the outreach and then connect with the kind of pre-vet, where again, we're going direct to owner. And then we have the acquisition side, which once we get them, we find out they're kind of pre-vetted, then we kind of dive in there and see if we can make something happen quickly. And so far it's been great. And there's 4 assets which were done outside the fund, which provided the business case and helped to shape the strategy for the fund. And now that our pipeline is getting fuller, the fund is going to see some really exciting growth, and investors are really jumping on board for it.
Yeah, for sure. That's awesome. Man, it makes a lot of sense, especially right now. And like you said, it may dry up at some point, but for the foreseeable couple years, that sounds like a strategy that's going to work really nice for you. One last time, to where to find and get their free copy of the book.
Yeah, so passiveinvestingmastery.com, passiveinvestingmastery.com/book. That's the website. Feel free to jump in there. Make sure you put the Wealth Flow podcast in as a promo code. And also set up a call. Love to chat with you wherever you're at in your investing journey and get to know your goals and see if we can get you pointed in the right direction. A lot of great passive investments out there to be discovered. So happy to help be the person to unveil those.
Absolutely. All right. Well, thank you, Patrick.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.